November 2026, artificial intelligence stocks stopped moving as one trade. Nvidia and Meta fell. In the same week, Alphabet surged, same sector, same AI story, opposite direction. For over a year, the assumption was simple: own AI, win together. That assumption just broke. Wall Street isn't grading the idea of artificial intelligence anymore. It's grading who can actually turn AI spending into revenue and who can't. Here's the mechanism. Alphabet, Google's parent, has been on one of the largest spending sprees in corporate history. According to its own SEC filings, capital expenditure went from $32.3 billion in 2023 to $52.5 billion in 2024 to $91.4 billion in 2025, nearly triple in 2 years. It hasn't slowed. In the first quarter of 2026, Alphabet spent $35.7 billion, more than double the same quarter a year earlier. Normally, that kind of spending scares investors. It eats profit. Not this time, because Alphabet has something to show for it. Its Gemini AI model, folded straight into search and cloud, products people already pay for. Nvidia sells the picks and shovels, the chips everyone needs to build AI, but its growth depends entirely on customers like Alphabet spending at this pace and staying convinced it pays off. JP Morgan put the new rule plainly: even a strong earnings beat isn't enough anymore. Investors need proof AI is a tailwind, not a headwind. Spend big and show the payoff like Alphabet and get rewarded. Spend big and leave the payoff unclear, and that same spending reads as risk instead, which is what just happened to Nvidia and Meta. This is no longer a sector bet. It's a stock picker's market inside AI itself. The rotation shows something bigger. The entire corporate world is now being forced to answer the same question. 5 years ago, generative AI barely showed up in company filings. One single company mentioned it in a 2021 annual report, according to SEC records. By 2025, that number was 859, including 164 of the S&P 500. Translation: nearly every major company now has to tell investors what its AI strategy is, or explain why it doesn't have one. And spending that heavily doesn't come free. Credit concerns are already emerging around Oracle, a major enterprise cloud player, over how it's financing its own AI build-out. If you own AI-adjacent stocks broadly, this changes your thesis. The story isn't AI will win. It's which balance sheet can afford to prove it. This has a shape investors have seen before. In the dot-com era, the market split the same way: infrastructure builders like Cisco versus companies that could actually monetize the internet. Most infrastructure names collapsed when spending outran proof. Here's where the parallel breaks. Today's leader isn't a story stock burning cash. Alphabet already runs a hugely profitable search and cloud business funding its own build-out. It doesn't need capital markets to keep believing just to survive. This isn't only a story about hype cooling. The market rallied hard on rate cut hope in November 2025. The Nasdaq's biggest single-day jump since May, then reversed sharply on AI disruption fears just months later. Same macro backdrop, opposite verdict once earnings came due. Short-term weeks. This is a positioning problem. Rate cut bets are already being repriced. Traders priced an 89% chance of a December cut, and the Fed delivered one. By February, Bank of America was arguing the Fed won't cut again under Chair Powell after a stronger-than-expected jobs report. That disagreement alone is moving markets week to week. Medium-term, quarters. Enterprise software is on a deadline. SAP has set December 31st, 2027 as the hard cutoff to migrate off its older ECC systems onto its newer S/4HANA platform. No extensions expected. Germany's e-invoicing mandate lands the following year. Companies delaying that spending now will be forced into it by the calendar, not by choice. Long-term years. This reaches beyond software. GM plans to launch hands-off, eyes-off autonomous driving on the Cadillac Escalade in 2028. Egon, the insurer, is relocating its legal home from the Netherlands and Bermuda to the United States that same year. If you work in insurance, auto, or enterprise the AI transition isn't a headline, it's already on your calendar. Here's the disagreement that matters most. Deutsche Bank has the S&P 500 reaching 8,000 by the end of 2026, a genuinely bullish call. Bank of America is warning the Fed won't cut rates again under Powell this year. Both can't be fully right. What would settle it? The next jobs and inflation reports, and whether Alphabet-style spending keeps converting into revenue growth or just into bigger capex lines with nothing behind them. Watch Alphabet's next earnings call. If spending keeps doubling and revenue doesn't keep pace, this rotation gets a lot more violent.